If there's one thing that I've learned over the last 2 years of trying to be a stock picker is that investing is so freaking hard. Oh my goodness. This thing is so hard to actually do. Let's just go through some of the companies that I thought I was a genius for finding and investing in. So if we just go through my speculative investments stock watch list, we can start off with Airbnb. Airbnb has been the only one where I've been like, you know what? I've done okay with this investment. I've done okay. I bought the thing when it was around $145 and it's at $159, which is about an 18% return. It's not too bad. Like I've not done too bad with Airbnb. I'm kind of happy with how Airbnb has gone for me. Even though at the same time, it's like this stock can definitely go anywhere from this point forward. If we look at any of the other ones on this list, it's going to look really bad. Alibaba, I was like, you know what? Charlie Munger is a genius. I'm about to follow Charlie Munger. If we look over the last year, dog, that thing looks painful. I bought this thing around this $220 price and it just kept on falling. And I was like, you know what? Average down. And then the thing kept on falling. It was like, average down. And then it's like, oh God, this hurts so much. This thing hurts a ton. And then if we look at CrowdStrike has been doing pretty well, except for where I bought it at. You know where I bought CrowdStrike? Where the hype was at its ultimate. I bought CrowdStrike around $260, and that thing, it just keeps on falling. And then if we look at any of the other ones, like the one that I talked the most about, oh my gosh, Lemonade. Oh, Lord have mercy. Lemonade is like, I bought this thing. I knew I was overpaying. I bought this thing around $80 a share. And look at this thing. This thing is now $22 a share. And when it was at $80 a share, I was like, yo, this thing is overpriced. But you know what? I'm looking at this for the long term. Everybody says all this stuff, right? But look, how many of us actually truly believe the things that we be saying all the time? Like, we listen to Warren Buffett, we listen to Charlie Munger, we listen to Monish Pabrai, we listen to all these great investors who say all these wonderful things, give us all these tidbits of wisdom, and then we believe that, you know what, I could do the same thing. I can be a great stock picker too. But the fact is, most of us can't. Most of us cannot do what they do. That's why they are special. That's why they're able to make the returns that they make, because they are special. These beings are special. A lot of us look at Warren Buffett, we say, oh, he's a cute old man. He has a lot of good wisdom. I'm just going to follow what he says. But we don't realize just how much and how intense the things he's asking you to actually do. When he talks about, oh, you know, be fearful when others are greedy. Do you know how hard it is to actually be greedy when other people are fearful? Because it's not like people are just fearful for no reason. There is a reason why people are panicking. It's not like people are just panicking for no, there's actually something going on that causes people to panic. And to think that you would be the one person, or in my case, to think that I would be the one person to be like, forget all of that stuff. I will be able to stand in the storm and withstand everything. It's extremely laughable to me for me to just think back to about a year ago, to think like, yo, bruh, I got lucky during the pandemic, and then I thought I was the greatest thing since sliced bread. I thought I knew exactly what I needed to do when it comes to investing. But in reality, I don't. Which is why Warren Buffett gives the advice of invest in the S&P 500. Like, most people should be investing in the S&P 500. Which nowadays, I'm gonna need more people to be putting respect on the S&P 500's name. Like, they will be talking down on the S&P 500, talking about, oh, the S&P 500 only gives you like 7 to 8% return. How good can that be? I can outperform that thing by myself. And it's like, we need to start putting some respect on the S&P 500's name. I read a little article from my favorite writer, Nick Majuli, and he pointed something out that was really, really interesting that I don't think a lot of people actually have noted about the S&P 500. He said, with economic and technological development over the time, new companies have been brought into the index and old companies have been kicked out. As Jeffrey West stated in The Scale, the universal laws of life, growth, and death in organisms, cities, and companies. Of the 28,853 companies that traded on the U.S. market since 1950, 22,469, which is about 78%, have died by 2009. Of these, 45% were acquired or merged with other companies, while only about 9% went bankrupt or were liquidated. 3% privatized, 0.5% underwent leveraged buyouts, 0.5% went through reverse acquisition, and the remainder disappeared for no other reasons. West research shows that public companies in the U.S. are in a constant state of flux. Based on its analysis, roughly half of all public U.S. companies in existence today won't be in existence a decade from now. They will either merge, be acquired, or go bankrupt, or find some other way out of the market. Because of this, what we call the market changes from year to year. More importantly, this rate of change might actually be accelerating. As the chart below from the Insight study illustrates, the average longevity of a company in the S&P 500 index has been on a gradual decline over the past few decades. In 1965, the average company tenure in the S&P 500 was 33 years, but today it's closer to 20 years. While this metric isn't a perfect measure of creative destruction among US companies, it suggests that companies in the S&P 500 are being replaced at a faster rate than in the past. Regardless of how quickly companies are moving in and out of the index, you can see that owning an index is fundamentally different than owning a basket of individual stocks. While your basket of individual stocks will remain the same over time, the index will not. And he called out something else. He said, but this isn't the only way in which a stock is different from an index. The returns are far better in indices as well. As I stated in chapter 18 of Just Keep Buying, if you look at the universe of individual stocks in the US going back to 1963, the median 1-year return is 6.6%, including dividends. This means that if you grabbed an individual stock at random at any point in time since 1963, you would have earned roughly 6.6% over the next year. However, if you did the same thing with the S&P 500, you would have earned 9.9% instead. The point that this is trying to make is, a lot of us think like, oh yeah, just invest for the long term, invest for the long term. But it shows like, even though you're investing for the long term, are you picking the actual right companies that's going to outperform over the long term? Do we know what those companies are? I'm not saying that you can't do it. There are some people who are extremely special and are able to do this. And if that's you, more power to you. But I'm just saying that for a majority of us, for most of us, we probably just should be in the index because the index is momentum driven. In other words, when a company starts sucking, they kick them out. And when a company is doing well, it gets added in and it drives the return of the index. Generally, most of the returns from the index are driven by like the top quarter of companies that drive most of the returns. And usually it's not companies that most people will be like, oh yeah, I saw that one coming from a mile away. No, most of the time, there was a time when Apple was not seen as the biggest thing ever because everybody was like, oh, they've already saturated the entire market of iPhones. Nobody wants an iPhone anymore. Or there was a time when everybody thought like Microsoft was just dead. Like Microsoft was making money, but nobody really invested in Microsoft for almost a decade. The point that I'm trying to make is, are you sure that you're the type of person who can pick out those stocks? If you are, man, can we talk so you can teach me how to do this thing? Because, you know, we could make some really good returns. I'm just saying. I'm just kidding. But if you are, more power to you. If you're not, and if you've seen over the last few years where you're like looking at your portfolio and like, oh my God, like, what am I going to do? Like, I'm losing a lot of money. If you're in that position, it might be time for you to start thinking like, yo, index funds are probably the way for me to go. For example, for me, even though I love talking about stocks and I have a portfolio of stocks that I share every so often, majority of my money is just invested in index funds because I know I'm not smart enough to actually beat the market. Maybe I could. Maybe if I put more time into it, I could. But then again, it comes down to something that somebody told me is return on headache. Is it worth it? Is it actually worth it? Shout out to Andrew Latondra who said that to me one time. Is it actually worth it? Andrew and also Jay Money, who both of them said the same thing to me one time. Is it worth the return on your headache? So it's just something for us to actually think about when it comes to picking stocks. Do we think we can actually do it? This reminds me of when Steph Curry first came out and Steph Curry was doing all the big things in the league. Like he was shooting shots from everywhere, making it look extremely easy. Everybody else thought, oh, you know what? I saw Steph Curry do it, so I can do it too. But there's only one Steph Curry. And there's a reason why he's the greatest shooter of all time. The greatest shooter that ever walked the face of a basketball court. There's a reason why. The dude is special. It's the same way with Warren Buffett, Charlie Munger, Monish Pabrai. These dudes are special. We need to put some respect on their name. And we need to put some respect on the S&P 500 for the returns that it's been able to generate over years, over decades for each and every investor. But anyway, that's all I got for y'all in this video. I hope y'all learned one, maybe two things out of this entire thing. And if you did, share this video with one person that you love, one person that you hate, and one person you're just kind of like, about. And by that time, you'd have shared it with every single person that you know. But anyways, be your boy Kelechi. I'm gonna catch y'all up in the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all, and I'm out. Peace. Whoosh.